Alrighty, so I'm filming this options tutorial on how you can capture different areas on what a stock might do through iron condors, butterflies, talk about what kind of areas you can kind of capture. So the first thing we're going to kind of talk about is an iron condor, and I'm actually going to kind of draw this out on something like Boeing. So let's say you actually think a stock is going to go sideways. Maybe you think the implied volatility of the options are super high. You think the stock's going to go sideways because it needs to consolidate because it just had a huge move. Let's clear this drawing set. And let's say I think Boeing is going to stay between 180 and 185 for the next week, maybe 2 weeks. We think Boeing's going to stay within this range. Let's say I think Boeing's going to stay in this 185 to 180 range for the next week or so. Well, you can actually make money the longer Boeing stays within this range from 180 to 185. And how you do that is you go over to the option chain, you go to Boeing, BA. Let's let this load up. You go to trade options, and let's say you think it'll happen, you think Boeing's going to stay in this range for 2 weeks. As long as by the end of 2 weeks, Boeing is between 180 and 185, you're going to make the full credit. So let's go 3 weeks just because I have an in-out spread, as you can see right here, which there's a whole video on in-out spreads. But basically, so we want it to stay between 180 and 185. So what we do is we sell the 185. And this is a 4 transaction order. So you can see your transactions starting to go over here. Nothing's set in stone until you click continue. Then you flip over to buy. You actually buy the further out strike. And look, it should show you total credit, 115. And now this in and of itself is a bear call credit spread, and it's called a bear call credit spread because I will make money as long as Boeing is below 85. I'll make all $125. It's like the reverse of a debit spread. You're selling the debit spread to somebody. And so I'm going to collect $118 right up front. That cash is going to go into my account. However, it's going to put up a collateral of $250. So because we still think Boeing's going to hold that 180 support, let's sell the 180 put, and then we buy the 177.5 put. And there we go. We have all our transactions in. It says total credit 230. Now, as long as if we execute this trade, it's going to probably take a collateral of 250. Let's see. Because that's the maximum risk. Make sure you always check the collateral, 2.3. And you can hit review order. So min credit $230 if Boeing stays between 180 and 185 in the next 2 weeks. And so that's a pretty tight range. So they're offering up a lot of credit for it. So actually, if I were to take this trade right now, so my collateral is 250. That's how much I have to give up. But I'm getting 230. So what's the most I can lose? The most I can lose is $20. $20. That's it. Collateral minus the credit. Most I can lose is $20. That's a pretty tight range. I'm still not going to do it. That's still a pretty rough fill to get. You might get filled at like 215 or something like that. So that's an iron condor. You sell a call credit spread and you sell a put credit spread. So we kind of talked about that. If you are really good at guessing or retracing how a stock might close a certain day, then you might want to do something like a butterfly. So let's go over to SPY. And let's say by the end of the week, I think SPY is going to hit 326, but not go past 326. So SPY, let's go to the daily chart. Let's say I think SPY is going to go up to 326, but not past 326. So that's somewhere about up here. A lot of lines on the chart, but bear with me. So let's go to the option chain. And generally for butterflies, you want to go with the shorter expiration because this is going to mature on expiration day, as with all options that are spreads and not naked options. Naked options lose value over time. Spreads, as long as you're doing them correctly, you're going to make money over time. So let's go with July 20th, just for simplicity's sake. So let's say I think SPY will go up to 326, but not past. Well, the wider the butterfly you make it, the better. So I'm going to buy, make sure you're on buy, the 324. I'm going to sell the 326 because I don't think it'll go past 326. And then since I really don't, so this in and of itself is a debit spread. But, oh boy, I even have other strikes there. Let's move out one more expiration. But that's a debit spread right in and of itself. The cost is 71, which is weird. Risking $70 to only make 30. Come on, Robinhood. There we go, 22. So I'm just going to clear this off. If you ever just want to clear, just hit the little X's. So we start off with buying. So I think, so this is now next Wednesday, but bear with me. So 324, buy the 324. I want to give myself a width of a nice $2. So the most we can make right now at this point is $200. That's the max credit we can receive. I'm going to sell the 326. Come on, Robinhood. There you go. Sell the 326. And then what you have to do again is you buy 2 strikes over. 2 strikes because that's what I picked. You could do this with 1 strike, but then the butterfly is really tight. And now look how it says total cost $199. That's actually not the total cost for the butterfly. What you need to do is you need to drop down and you need to go to custom. Custom, and then you want to sell 2 of the 326 because you really don't think it's going to go past 326. That's what differentiates it from a debit spread. A normal debit spread is buy 1, sell 1. This is buy 1, sell 2, buy 1. And so your total cost is $19. The most you can make is $200 if SPY on July 22nd closes at 326. So for viewing points, let's pull up the 180-day chart. Actually, let's pull it up on the left side. I'm doing this live as the market's going right now, so SPY's having a little bit of a sell-off. We had a little bit of a bear flag. Oh, and just to recap this Boeing trade, so where do you lose on Boeing? Well, you lose on Boeing if it goes past 185 on the top side, or if it goes past 180 on the downside. So that's where you lose on the Iron Condor, and you would have lost $20. The most you could have made is $230 if Boeing stays within that range. But back to SPY and the butterfly, let's kind of map this out. So we bought the 324. So that means we make money from 324 up to 326. That's up here. And we're going to make this green. Edit properties. Color. Make it nice and bright green. And then past 326, we lose our $20 because we didn't think it would go past 326. So anything past 326, we make red. We lose our $20. Anything before 324, we lose money. So as you can see, you kind of have to like hit it like a bullseye for those butterflies. However, if you do hit it, you just turn $20 into $200. And so that's why butterflies, they're generally lower probability So only do them if you're, I don't know, crazy. I don't do too many butterflies, but because that's kind of tough to hit. And that's on expiration day. So none of it really matters before expiration day. But on expiration day, you let's say it closes at 325, that means you made $100. If it closes at 326, you made $200. If it goes to 326.50, you made $100. If it goes to 327, you're gonna lose your whole $20 investment. So those are butterflies. They're better for short term because it's easier to predict price pattern short term than it is long term. So that's the butterfly. If you have any questions, we'll talk about back ratios, more about credit spreads and all that other stuff. But today we covered the iron condor and we covered the butterfly. Okay? So let me know if you liked this video. Give me a thumbs up if you liked it. Give me a thumbs down if you didn't like it. That's my feedback indicator. So yeah, let me know if you have any other questions, comments, or concerns. All right, see ya.